Thank you for joining us today. I'm John Roselle, the Chief Investment Officer and a partner at Sendero Wealth Management. It's a pleasure to speak with you today and bring you our second quarter update. We're recording this on the afternoon of July 2nd, and we're pleased to have with us today Anne-Marie Conti, who is a partner and heads up our research effort and our institutional portfolio management effort at Sendero. In addition, we have Rodrigo Lopez, who is also a partner and heads up our investment due diligence process. And in addition, we're fortunate to have two of our advisory board members with us today. Thano Hasiotis, who has been a Wall Street analyst and a hedge fund portfolio manager. And then in addition, we have Patrick Kennery, who has been both a trader at a hedge fund, as well as being the chief investment officer of a major macro-related hedge fund as well. So with that, let's move right to discussing where we're at in here at the beginning of the third quarter of 2026. And to do that, I'm going to ask Anne-Marie to review what our expectations were as we entered the year when we publish our bull and bear scenario analysis. Anne-Marie, do you want to elaborate?
Yes, thank you, John. Yeah, it's crazy to think that we're halfway through the year already. And we started 2026 with the S&P at 6,800. And our expectations for our base case for 2026 for the full year was a modest rise in equity markets. Let's call it about 7,200 on the S&P 500. And this was a continuation of some of the monetary policies, relatively benign news on the tariff front, a decent earnings season. And then what's kind of still out there is midterms. I'm sure we'll get to that at some point. What we didn't have in our scenarios were two events. First, we had a very, very brief kinetic actions in Venezuela, which the market very, very quickly discounted. But more importantly, what happened, of course, in the Middle East with the Strait of Hormuz. So as you look at what's happened from first quarter and second quarter, we finished the first quarter down in the year. As a reminder, we're down about 7% at that point on the S&P 500 through March 30th. And then since then, we had this massive rally, let's call it about 20%, going from about 6,800 to 7,600 on the S&P 500 in the span of 2 months. We've given up a little bit of that of late. As we close the quarter, second quarter, S&P is about 7,500. Still a very good 10% year-to-date basis on a total return. And finally, just as a point of reference, that 7,500 was the bottom of the range of our bull case that we had identified for 2026, which again was about 7,800 to 7,500. So even though we're at a very good level from a market return, as the rest of the team will be discussing, is how did we get here and what we're seeing internally in the market.
Thank you. And I do think that, one of the things we cautioned everybody at the beginning of the year, that a lot of these expectations were going to depend upon how earnings turned out in 2026. And the reality is, broadly for the S&P 500, we've had extremely attractive earnings growth. And the numbers have really been quite substantial, which is an important backdrop for the market. With that, let me ask Rodrigo to elaborate a little bit. He's been doing quite a bit of work on sort of trying to understand what drove the market return in terms of what areas where returns really being seen, because it hasn't just been uniform. Well, the S&P 500 over the last quarter is up substantially. It hasn't necessarily been that broad a rally. And so, Rodrigo, with that, why don't you elaborate on some of the work you've done on the different factors that have driven the S&P 500 this year?
Yeah, those are all good points because since the war and since the drawdown, which reached right about a negative 10% return for the S&P, the snapback of equity rally, the equity rally and the performance came from a very narrow band of names. Those names are all either artificial intelligence or beneficiaries of the artificial intelligence trade. And those earnings have been very robust. So the market's been willing to pay up for earnings clarity through 26, 27, and 28. And those names have very asymmetric returns. We had some who were value names at the end of 2025 being up over 100%, some over 200% for the first half of 2026. The big beneficiary of the AI trade has been memory. So this would be the closest to selling shovels in a gold rush. And the rest of the market has been discounted or very much re-rated downward because it has no AI or robust earnings growth expectations, which we think at this point can be a little lopsided from a performance standpoint. So our portfolios have also been positioned for the everything else part of the market, which is represented by quality and value, despite the strong performance in the momentum factor. And momentum is most easily defined as being that the winners in the recent past keep winning and keep getting rewarded for that growth. From just a performance standpoint, the S&P for the first half of the year was up about 10%. Growth equities, U.S. growth equities were up about 5%, and value equities were up about 16%. Internationally, we saw some good performance as well. Developed markets were up close to 20. Emerging markets rallied, especially towards after the war, quite substantially, given the exposure to AI, to energy, and to some of the second order derivatives in these trades. The surprises have been mostly on value names. These value names more representative in what we track in terms of exposure, which is the value factor ETF, and that's just a proxy for whatever the market is recognizing as value. That's up 50% year to date. About half of that performance came from Micron, which now represents about 25% of that index or the factor ETF. So we see a lot of dispersion. That dispersion has been a dream scenario for the hedge funds. They have been able to capitalize on the long side and on the short side of these trades. And lastly, stability has earned its name in fixed income. It's been continuing to yield quite attractively and has been relatively stable for most of the year.
Thank you. That's great. And I think, with shifting to Thano, we're going to discuss in more detail specific names that we really saw. But I do find it fascinating that names that sort of slipped into the value index last year aren't companies we necessarily would have thought of as being value names, but tended to be, as you said, semiconductor or memory names, which are almost like a commodity business in reality, that have just had unbelievable growth this year. So with that, Thana, would you like to elaborate a little bit on some of what you've observed in the market with who the winners and who the losers have been and how the market has rotated?
Yeah, thanks, John. So just to start off, when you see the S&P, like Rodrigo said, up 10% for the first 6 months of the year, you look a little bit further, and the NASDAQ is up 16%, and the Russell 2000 is up almost 20. Underneath the hood, individual stock correlations are at 15-year lows. So what that means is not everything is going up. together, not by a long shot. In addition to that, over the last several years, we have been used to a market where if it's up, low double digits, the mega cap names are contributing to that or even driving that. And that has absolutely not been the case for 2026. And I just want to go over some names that everybody sort of knows and recognizes. These are trillion-dollar plus market caps that are not contributing to the index overall. For example, Microsoft is down 25 to 30%. Meta is down 15%. Traditional names, Tesla is down as well, down 5%. That's moved around a lot lately. But traditional names that you would think that would contribute that are very much squarely in this AI trade, like Broadcom, that's only up 4%. NVIDIA is up only 4%. Amazon, 4%. The only one that sort of kept track at all is the sort of perceived leader for now, which is Google, which is up about 15%. Not only that, the volatility in these huge mega cap names is pretty extreme. So, for example, Microsoft didn't go down in a straight line. I mean, Microsoft went down from 500 to 360 and then bounced 30% just a few weeks ago, and then has come completely back down. That is a hedge fund's dream scenario. Broadcom the same way. It's only up 4% year to date, but at one point that stock was up 44% just a few weeks ago. So where are we seeing the strength? Rodrigo talked a little bit. Let's look at some of the major software names. Not there for some of them. Salesforce.com down 40% on the year. ServiceNow down 30% on the year. The strength has come, and I just want to put some numbers, as Rodrigo said, Micron up over 250%. That has reached a $1 trillion valuation, whereas before nobody paid any attention to it. Intel up 240%. AMD up 150%. Now, here's what I love about this market right now if you are a stock picker. The market is deciding very carefully who wins and who loses. So they didn't put their money behind NVIDIA, even though NVIDIA's numbers were great. They put their money behind the memory chip guys. They looked at the software sector. They were concerned that AI could replace a Salesforce.now or Salesforce.com or ServiceNow. Where they did put their money in the software space, security, CrowdStrike up 60% on the year. Palo Alto Networks up 80% on the year. Now that's just inside the AI world. And as a backdrop, I want to remind people that we had a huge increase in 2026 for CapEx spending by the AI hyperscalers. It's about 750 billion this year, which is an 80+% increase. The forecast for next year is still up, but it's a little bit of a slowdown, not much, more like 25% to around 950 billion. So the impetus driving, these names is still intact. And the market has decided that there are other interesting ways to play out outside of simply the tech world. So for example, the biotechnology index, which probably can apply AI very well to the work that they do. That index is up 30% in the first 6 months. In industrial names, some of the industrial names, particularly some in the Dow component, like Caterpillar, that stock is up 70%, boring old machinery. GE Vernova, for the power side of it, is up 74% this year, and it's had a great run over the last few years. Even stocks like Eaton are up 30%. Many other names, though, aren't participating. Your Emersons, your Dovers, your Parker Hannifins, your Boeing. I mean, they're up, but they're not driving the sort of index growth. So, overall, when I look at this market, the investors are trying to figure out who wins and who loses. And I think, I'll let PK touch on this briefly because he's talked about it now for 6 to 9 months. But as people become concerned about the money spent by the hyperscalers, they may think about re-rating those names. They have to do it because they have to win, and there will be some winners. That's probably why you're seeing the volatility in some of those names, and you're seeing the distinction, because the market is almost I can't sort of say, oh, I own this moat stock with a monopoly and I've got great free cash flow and I can kind of forget it. You can't do that anymore because they're spending all their money on AI CapEx. What you're trying to figure out is, are they going to be the winner or are they going to be the losers? So that's why you're likely to see continued volatility in these large market cap names as people almost trade them a little bit like in a VC sense. And people's perception of the winners will change again between now and whenever the cycle completes. But I would say that this would be sort of a hedge fund dream scenario for those active managers and those fast traders.
You're right in terms of what you say there. It's very, very suitable or very attractive for people who can be long and short and people who turn their portfolio over a lot. Much more challenging for the long only community as a whole because of so much rotation that's taking place. Patrick, let's shift to you and just, two pieces following on, and just so that everybody knows, we commonly refer to Patrick as PK, and have for years. But and that's what Thano was referring to. But Patrick, first I want to just touch on your thesis about the capital intensive nature of what you historically were capital light businesses, and that's a real fundamental shift that's taking place here.
Yeah. So thanks, John. So first, what I would say the hyperscalers are really the I guess the Mag 5, Apple, Google, Microsoft, and Amazon. And Amazon doesn't fit quite as much because they had a decent amount of CapEx for a long time. But all of those companies were sort of the perfect company for the 2010s. That was a period of very low growth. Remember, the story was secular stagnation. Inflation was very, very tame. The concern was deflation. The Federal Reserve was running, extremely loose monetary policy to try to prevent deflation. And meanwhile, you have these companies who were growing earnings and had huge moats. Effectively, they were monopolies. And the reason monopolies are illegal is because they restrict output. Effectively, what they do is they don't produce like the maximum amount that they can produce. They produce what maximizes their profits. And all of these companies in their niche were effectively monopolies. And so they were valued and should have been. In fact, they were probably undervalued for that during that period because people maybe had a hangover from the tech bubble of 2000. They considered them far riskier than they really were. They were, in fact, like incredibly low risk companies with huge financial power. They had lots of net cash. They just bought back stock with the excess. And what's happening now is it's kind of almost unique is they're now in a prisoner's dilemma, like from game theory, where they feel like it's a matter of survival to now spend a lot of money. Like one of the main benefits of being a monopoly is you don't have to do CapEx. You can restrict your growth and just maximize your profits. Now they're embarked on this challenge where they're all competing with each other, spending, as Thano said, on the order of $700 billion this year to try to build out something. It may end up, I have no view on whether this ends up being super profitable. There are plenty of very smart people in these companies that believe it will be profitable, but it is the future. The future is uncertain. And they're now deploying this money in something far riskier than buying back your own stock. And risk tends to get a discount in asset prices. That's just basic finance, is that if the cash flows that you're expecting are riskier, you want to value those cash flows at something less. And so it makes sense that there might be a re-rating in some of these companies, and they've already seen it. Some of the PE ratios on these companies are actually look like normal industrial companies, which in fact, they're becoming more like normal industrial companies. They have lots of CapEx and they should be priced accordingly. And then the other aspect, and maybe I'll segue into more of a macro aspect of this, is that $700 billion is material to US GDP. And it's really unique to the US, the scale of this investment. So it's created a growth tailwind that is not cyclical in the sense of a normal economy where consumers spend and then they overspend and they cut back. And this is not part of like a normal economic cycle. It may run the cycle of financial booms. So this capital spending that these hyperscalers are doing is actually driving growth within the US. It's a big part of GDP growth in the first half. We haven't gotten first half GDP yet, but it was big in the first quarter. And that is a very different posture than what they had the last decade when they were not contributing to GDP in terms of CapEx. And that is unique to the US, and it is most likely contributing to elevated interest rates within the US. And I think it's important now, I'm going to segue now and talk about interest rates, is there has been a narrative really ever since the Ukraine war started that interest rates are up, and there's, if you look at the 10-year yield, it's up substantially, something like 3% since the beginning of 2022, that was because of inflation. And that inflation expectations are pushing up bond yields, pushing down bond prices. And it is, once again, we have the war that just with Iran, that the same thing, it pushed up crude prices, which should be pushing up inflation expectations. And that's why bond yields are relatively high. But first, we'll just talk about the macro aspect of that. I think there is a lot of confusion in talking about interest rates, about what is inflation and what causes inflation. Supply shocks in and of themselves are not inflation. So crude oil is an extremely inelastic, both supply and demand for crude oil are extremely inelastic, which means small changes in either supply or demand cause the price to move a lot. And it moves very fast. And so it can have an impact on any consumer price index, any inflation index. But if that rise in prices in crude oil is not supported by an increase in credit and money growth, it won't become that is not inflation per se. It's just, even though it may cause the index to go up. What's going to happen if you have higher prices without an increase in the supply of money to pay those prices is people have to cut back on something else. But the things that they cut back on don't have that same inelasticity. Their prices don't move as quickly. And so you get the net effect is a rise in the index, in the consumer price index in the short term. But over time, the lack of spending on other things will tend to depress those prices, but it's spread out over much longer time. And then that is sort of the first order effect of having a supply shock in something important like crude oil. But then the second order effect would be if there are commercial activities, businesses where crude oil is a major input in what they do, and their customers are unable to pay higher prices for whatever it is they produce, they're going to have to cut back their production. Either that or they have lower profits. And so there can be second order effects, termed demand destruction effectively, where activity across the economy slows down. Now, that's just a general description of what a supply shock can do to an economy. As I said, the US is now at the same time in the middle of a CapEx boom. And so the US economy seems to be weathering the war and the higher crude oil prices pretty well. In addition to there being a CapEx cycle, the US is now a net exporter of energy, of hydrocarbons. And so it's not, the impact is not a one-way thing like crude oil price rises that happened back when we were a major net importer. But the rest of the world is it's certainly the rest of the developed world that are not energy producers and are not participating in the AI boom to the degree that the AI investment boom to the degree that the US is, it makes sense. And we're starting to see some data that those economies are starting to slow down a bit. But how this affects interest rates, and just to take a step back, we have a new Fed chairman. They had their first meeting where he was chairman last month. And I think the narrative about him coming in was that he was going to, because Trump has been very vocal about wanting lower interest rates, that he was going to be a dove or be aggressive in cutting interest rates in the face of this inflation problem. And I guess my point is maybe the premise of that whole idea is wrong, independent of whether this is Kevin Warsh, whether Kevin Warsh, the new Fed governor or Fed chairman, is going to be dovish or not, that people may just be wrong about what the expectations for inflation should be. Because, and the war has exacerbated that because all of the discussion, if you watch all the media, is that inflation is going up because of the war. But if you look, and I have a chart here that I can show, it's two lines. The yellow line is inflation expectations as implied by the bond market. You can discern and this is the 10-year expected inflation rate, that you can find that by looking at the price of a treasury bond versus the price of what's called treasury inflation protected securities, or TIPS. And the difference between those tells you what the market is expecting for inflation. And the second line, the white line, is the other half, what's called real interest rates. So it's the treasury rate minus whatever the inflation rate is. So what is the real rate without sort of the devaluation of the value of the dollar that you're earning when you own a treasury? And if you look at the history of this, the entire bear market that we've seen in bonds that began in 2022 is in fact in the real rate. Inflation expectations are effectively where they were in the end of 2021. In fact, if you sort of then zoom in and look at the last 6 months or year, inflation expectations are below where they were at the start of the year, and they're well below where they were when the war started. So despite the mechanical aspect of crude oil prices pushing up the CPI, and what these are telling you is what does the market expect the CPI to be over the next 10 years? The market is saying we expect CPI to be lower. And as I said about the effect of a supply shock on inflation in the economy, the market has effectively, whether it's conscious of this or not, it's effectively agreeing that this is not an inflationary event. Meanwhile, central banks are, Kevin Warsh in his first news conference, he did not pre-commit to any sort of policy, but he was very clear that he was going to make sure inflation did not go up more. Many of the Fed governors are very concerned about inflation being higher. The European Central Bank raised rates last month as well, because they were worried about the inflationary effects of the war. So if anything, there's a bit of a divergence between kind of the reality in markets of what it expects for inflation and what central banks are doing. I think it sets up for potentially rate cuts come rapidly later on, either later this year or early next year. But at a minimum, I think unless something changes in these dynamics, and I did mention crude oil prices are back almost to where they were before the war as well. But unless something changes in these market dynamics, I think concerns about inflation are overblown and interest rates are likely to be stable or better going forward.
Thank you. I think one of the points to make there actually is that real rates, which is what you're really earning on fixed income investments, and what you really have to be concerned about, is significantly higher and much more attractive actually than it has been for a very long period of time, which, given the uncertainty in the equity market and the potential rotation that we see taking place in equities, does make fixed income relatively attractive. People don't tend to think of it that way because they're very focused and worried about Fed raising rates and so forth, and just the size of government demand for rates. But there are pockets of the economy that really need rates to come down as well too, and they need long-term rates to come down.
One thing that relates, both Kevin Warsh mentioned this during his press conference, and it goes back to the AI boom and the investment boom, is one thing that could be pushing up real interest rates is the investment boom. The basic theory of interest rates is it's the price at which the supply and demand for savings clears, and demand for savings is investment. And what Kevin Warsh said in his press conference is that real interest rates are not too high, obviously, for people who are doing AI investment, because they see their potential investment returns being much higher, but they're probably too high for things like housing. Housing is probably the sickest part of the economy right now. And but this investment boom is probably responsible for this. And again, the investment boom, according to the way the market is pricing inflation expectations, it's not inflationary, but it is potentially, it's having an upward pressure on interest rates, where that kind of leads to your expectations longer term is if those rates are relatively high for the normal parts of the economy, things like housing and consumption, then it is probably going to rein in growth. As long as these real interest rates are high, it's going to rein in growth in the areas away from AI, which is kind of a self-regulating aspect of interest rates that they should, again, as conditions, if they remain the way they are, interest rates should remain the same or fall.
Yeah, good point. Thank you. Thank you for pointing that out. There are a couple of takeaways I think that we can have from this discussion, both in terms of equity market rotation that we've seen in terms of individual names. Well, the theme that clearly is driving this is AI and who's going to be impacted by AI. And we've seen a lot of rotation through, as Thano emphasized, the different types of names and where people sort of fit in that ecosystem, as to who's being rewarded and who isn't being rewarded. And some of these, aren't what you sort of first expect. But one of the factors that, we have to be conscious of with that is at the same time, earnings and the earnings power of a lot of the companies that have been negatively impacted have actually been very resilient, in fact. And if anything, as those equities have been hurt, the management of those companies are becoming more disciplined in how they're looking at their income statement as well, too. And so that's something to stay focused on. The second element I think that we have to think about with this, and it sort of touched on something like Patrick said about these companies becoming very, very capital intensive, and that really impacted what Thano was pointing about the re-rating in terms of what multiple people may be willing to pay for AI. Well, we're seeing this boom translating through to earnings power for a lot of the companies that are, in essence, suppliers to the AI boom. What we really haven't yet seen, and where the uncertainty really exists, is is there going to be true earning power for the people who are generating AI, the actual producers of that? We have to see the revenue flow for that. And that's where there's a lot of uncertainty at this stage, and where people get concerned about, is this a bubble or is this not a bubble from that standpoint? And when we look at trying to build portfolios, we want to make sure we're building portfolios that are resilient to all of these. Our alternatives portfolios have done very well because of all of the dispersion that has existed within equity markets in terms of winners and losers this year. Our fixed income portion of the market has really been, of our portfolios has really been quite stable as a whole. Where it's been more uneven is in our long equity allocation, either through our passive or through our active management. The passive has tended to benefit because the indexes as a whole have benefited. The passive or the active has not been nearly as beneficial because many of those managers are focused in terms of trying to really get to that last point. Where is this really going to result in true sustained earnings growth, and who are going to be the winners at the end of that? And that's taken a much longer time to play out from that standpoint, and that creates some of the volatility that we see. I think with that, we've gone a little longer than we probably planned, but if there are any questions, we're always here. We're always open for your questions. Don't hesitate to contact your individual investment advisor or reach out directly to us as well too. So at that, I'll close this webinar, and we look forward to speaking with you at the end of the third quarter.